What's up everyone, and welcome to episode 22 of our PerFinEx Community Investing, the birthday edition, because we just completed our second year of investing together. And what a ride it has been, huh? That's why I brought a present for you guys today. Big gains. Some of you guys have probably seen it already in their investment accounts, at least the people that accepted the order proposals already that we sent you this morning. Before we come to the most important investing news of the last months, the different portfolio developments and the rebalancing that we did, some of you may have been wondering where I've been and why there have been no community investing videos since May. The vast majority of you agreed with us that monthly videos don't bring a lot of value, especially since they were starting to get a little repetitive, to say the least. We brought you an email from one of you guys who enjoys her weekly dose of Axel with these videos because it sums it up perfectly. Doing these videos quarterly instead of monthly gives us the chance to improve the overall quality instead of just talking about charts all video long. And we focus more on the newsletter as well. Every single one of you investors should get an email with this video tomorrow morning, in case you don't see it today, to make sure everyone receives as much information as possible. Ready? Then let's start with the investing news. The US American Central Bank Federal Reserve increased their federal funds rate again by another 0.25% in order to bring down inflation. With 5.25 to 5.5%, that means the US has the highest interest rate since 2005. And they may continue to raise their key interest rate later this year. Now everyone waits for our European Central Bank ECB, what they will do next month when they make their next decision what to do with our key interest rate. One thing's for sure. Inflation will come back down at some point, and then central bankers around the world will pat themselves on their shoulder on how good of an economist they are. Which is a complete scam towards us consumers, if you ask me. We talked a lot about the inflation lie in February in episode 18 of our community investing, so just in short, because of the way inflation is calculated, by comparing prices year over year, it has to come down at some point, even if prices continue to increase. You can check out the older video, which is linked in the description, if you're interested in clearing this myth. And we also cleared another myth, or old stock market saying, in the last episode, which was that you should sell all your investments in May and go away, but remember to come back in December. Indicating you should sell everything in May, chill until September over the summer, and then in September you should invest again. We're gonna have the final numbers in the next episode, but at least for now, with only a couple of weeks to go until September, we can say the stock market saying was wrong again. What can we learn from this? Don't listen to the media that are just trying to get you scared with clickbait headlines. It's kind of ironic that I'm telling you not to listen to news while we're in the news segment of this video, isn't it? So, how can we as smart investors with a long-term investment mindset deal with all of the things happening around us? It's easy actually. We simply don't give a fuck. The simple investing strategy of dollar cost averaging, where you just invest every single month, no matter if the market is up or down, has been proven right and right again over this downturn that we've seen and over all the other downturns of the last years or so. I'm not saying it's over and financial markets will only go up from here, don't get me wrong. But for now we have very, very positive signs over the last couple of months. But it's still certainly possible that prices will come back down again. So don't get overly excited, please. Just continue to do dollar cost averaging and you'll be just fine. And here, I gotta give a big compliment to all of you guys. Only one single investor among all of you guys got cold feet, withdrew all his money, and closed his community investing account. Looking back now, it was the worst time possible, which is bad luck because nobody knew back then, but everyone else just stayed calm, relaxed, and continued investing. Huge compliment to all of you guys. Alright, Let's come to our high safety investing strategy with new charts as the interface of GetQuinn, the third-party website we use, continued to get better and better. In June last year was the absolute bottom because of the war in Ukraine, interest rates, inflation and whatnot. And then it shot straight up to almost the highest point in August, exactly 1 year ago. And since then, we continue to recover. Which is asking a lot actually, because this investing strategy is well over 60% in bonds, as you will see later on. And the overall environment for bonds was tough over the last years and continues to be tough. But we gotta invest so much in safe investments in order to keep our risk classification here. Year to date, we are up well over 4% in portfolio increase, leaving us with a tiny loss still of a little over 2%. And with the dividend you guys received, we are a little in the plus. You can see the dividend distribution for this year in the bottom. We expect exactly 300 euros in dividends this year, which would be a 3% dividend yield for the 10,000 euro exemplary portfolio here. Pretty good. Overall, I hope we can be in the positive dividend and positive portfolio territory in the next episode in November. In 2021, we were up a little over 3%. In 2022, about minus 10%, which goes to show you that bonds are in fact a little less volatile than stocks. And this year we are up so far by almost 6%, accounting for the portfolio increase and the dividends. And because it's currently going pretty good, we decided to make some changes to all three investing strategies to be better off for the recovery that hopefully started now. So please log into your Fidelity account and accept the order proposals, Ordervorschläge in German, that we sent you yesterday. Some of you already did it, and now you'll see what changed. In order to keep the risk classification, we have to invest at least 60% in bonds. Look at the traffic light, it's right at the border. Just 1% more stocks and less bonds means we fall out of the risk classification. Always trying to get the maximum for you guys. Here you can see more details on the bonds. It's 2 ETFs that I can't show you guys publicly without getting into trouble, but investors can see it when logging into their Fidelity account, of course. Let's just say we have a nice worldwide distribution of corporate bonds with a very nice yield. That's where most of the dividends are coming from. And if you check the performance that one of the bond ETFs made, actually 3.6% this year, and paid dividends too that are coming on top. It's pretty good. Next up is a perfect addition for this investing strategy and the passive income strategy as well. A Vanguard ETF, which is a mixture of different bonds and stocks. I love this ETF as it helps us to stay in the risk category and the returns are a lot more promising compared to overloading on bond ETFs only. And the other 20%, which is the rest of this investing strategy, 2 different stock ETFs in a 50-50 split that invest in the companies probably all of you know. Microsoft, Apple, Amazon, and more. Of course, because you cannot invest in broad market ETFs without the big tech companies really. I love this distribution, and we can see with almost 40% return this year, it's pretty profitable too. And just to prove my point, here's what I said in the last episode about this. Here we are still waiting for the recovery of the tech sector in order to come to positive returns. As soon as tech recovers actually, we will have multiple investing strategies with green charts. Told you so. Honestly though, the industries we are investing in here, tech, healthcare, consumer goods, are a lot better than finance, for example. Which is usually pretty tough to eliminate because finance companies are just everywhere, but their returns suck, so we keep them as low as possible. Passive income, your guys' favorite investing strategy, is green big time. 10% year to date and almost 8% since the start of our community investing, exactly 2 years ago. Who would have thought half a year ago or so that we've been sitting here talking about positive returns? All green today. I like it, you guys like it, hopefully we can keep that up. Dividends are also big with almost 500 euro you received so far with a 10,000 euro investment, a nice 5% distribution. That leaves us with a positive return of about 4% in 2021, minus 11% in 2022, Told you guys stocks are a little more volatile than bonds, and well over 10% plus so far this year. Absolutely awesome, and it feels so good to finally deliver some return for you guys. And here, you know the drill. We are going for the maximum allowed as well to deliver the best returns for you guys. And that is why we are adding the Vanguard ETF you saw in the high safety strategy just a moment ago, as well with 5% here. Otherwise, we fall out of this risk classification as well. The other 95% are invested in the stock market with a little over 17% return on average this year. The best ETF bringing a return of almost 40% since January. Insane. This year feels so much like the 2020 COVID year all over again. Short drop because of an event, the war in Ukraine this time, and now a steep recovery. And now you guys tell me that market timing works. Come on, bring the comments. In 2022, nobody expected the speedy recovery we had, and this year with all the worries about a recession worldwide, nobody expected plus 40% either. The stock market is certainly one crazy thing over the short term, and that's why we invest for the long term with dollar cost averaging. Again, we focus on tech and healthcare, the most profitable industries these days. And the third industry being finance. That's what I said earlier. When investing in broad market stock ETFs, it's very, very tough to not invest in finance. But at least it's 10% only, so we're fine. And now, my friends, the investing strategy with the biggest increase since the last episode. Of course, because it's the highest risk too. High return with almost 7% over the last 2 years. And don't forget the dividends. This year we expect almost 200 euro in dividend payments for every 10,000 euro invested, so almost a 2% dividend yield. Here we are still recovering from the year 2022, where I still admit, as I did in many episodes, that we try to be more creative than necessary in order to increase returns, which didn't work as you can see. But it still was a good decision to cut the losses instead of holding on to the losing investments. The only thing we could have done better is to cut the losses sooner. In 2021, we were up almost 6%. Everything was working just fine before all the craziness started. And then 2022 happened with a loss of about 20%. At least this year, we are up well over 10%, so the break even is very, very near. And I hope we can reach this with the next episode in November. The rebalancing here is just one single chart, as there's no restrictions in terms of risk classification here. That's SRRI 7, the highest. And if we don't have to invest in bonds, we're not gonna do it. That's for damn sure. The new portfolio is all stocks with a slight overweight of the US market because of the tech and healthcare portion of this investing strategy. And look how beautiful the industries are here, with the top 3 being healthcare, tech and consumer goods. And finance not even being in the top 5 with only 4%. And that's why the average return has been the best out of all 3 investing strategies, with 23.5% here. The best ETF bringing in, again, 40% since January. If we can keep that up, holy smokes. If you would like to take part in the recovery, no matter in which investing strategy, you can open your free Fidelity investment account in about 5 minutes, all completely online. Please fill all the details, including tax ID and everything, and identify yourself. Then we all have a very smooth process. You can identify yourself completely online with the Video Ident app that you can download on iOS and on Android, or you go with your passport into the next post location and do the offline post ident. After you completed your verification, it's gonna take Fidelity a day, 2, maybe 3, in order to open your account, and then we will reach out to you because we can see online that your account is already open. You have to wait for the initial password and your other login details to arrive. Let's make the most of it. Enjoy the summer, enjoy the recovery, and hopefully it continues. See you in the next episode in November, guys.